1905, and Merrill Lynch in 1914. Lehman Brothers, which ended with the financial crisis of 2007-8, became a member of the New York Stock Exchange in 1887. Most financial products, listed securities, perpetual bonds, commodities futures, options, were invented many centuries before the first banknote still in existence, which was issued by the Bank of England in 1695. The word cash itself is a recent designation in English. Even mortgage-backed securities, which I discuss extensively in Chapter 5, for the role they played in the financial crisis of 2007-8, were invented nearly 500 years before the crisis. In Chapter 3, I explain what investment bankers do and how they organize themselves to create economic value. In Chapter 4, I illustrate the basis of investment bank strategies with a simple matrix and show how they can differentiate themselves from their competitors. To illustrate these two important considerations, I use the example of Goldman Sachs. Chapters 5 and 6 deal with the most important asset of an investment bank, trust. Chapter 5 analyzes the causes and consequences of the financial crisis of 2007-8. I argue that the competitive pressure of commercial banks, long before the crisis, caused investment banks to enter new business lines essentially in trading. This led to financial innovation and to greater risk, and to the demise of independent, pure investment banks. Another consequence of the financial crisis for investment banking has been the severe decline in its reputation. The crisis led investment banking departments of global banks to find ways to reestablish trust with clients. The purpose of relationship managers, RMs, or client executives or senior bankers or simply bankers is to build and manage corporate-client relationships. In Chapter 6, I present 4 keys to successful relationship management, and I explain with a case study how a good RM grows trust with clients. See the case study, the year when Merrill Lynch France displaced Goldman Sachs to advise the largest M&A in the world. Trading is one of the key functions of an investment bank, and it was the most profitable function before the crisis of 2007-8. Trading was also a crucial contributor to the subsequent global financial crisis. The ensuing regulation of trading and the digital revolution gave new impetus to this business. In Chapter 7, I present the fundamental fragmentation of trading between on-exchange and other trading venues, between quote-driven markets as opposed to order-driven markets, and between lit or displayed trading and dark trading. The chapter concludes with an analysis of the competitive strategies of exchanges. In Chapter 8, I try to assess how regulation and technology shape the strategies of agency trading, principal trading, and proprietary trading, using the example of 2 controversial types of derivatives, credit default swaps and commodities futures. I discuss algorithmic trading, high-frequency trading, and the risk dimensions of trading, operational risks, and market risks. The chapter ends with the case study of 2 near-fatal and fatal trading strategies, that of long-term capital management, LTCM, compared with that of Lehman Brothers. In the traditional sense, investment banking is buying original issues of securities for public resale, which I cover in Chapters 9, 10, and 11. In these chapters, I show that investment banks sit between the seller and the buyer with opposite interests, and they try to do well by both. But the potential conflict of interest between the investment bank and its 2 types of clients, the corporate issuer and the investing client, is particularly acute in equity research, Chapter 9, and initial public offerings, Chapters 10 and 11. Chapter 9 shows what the Securities Research Division of an investment bank does and what the business models are in equity research with 2 case studies, the Enron fiasco and how Solomon Smith Barney's research model went wrong. I also discuss 2 puzzles. If markets are efficient, how can research be efficient? And why don't institutional investors pay much attention to analysts' recommendations? Raising equity capital is the traditional role of investment banks. Chapter 10 discusses the business of equity offerings and analyzes the 3 substantially different mechanisms for completing an initial public offering, IPO, auctions, fixed-price offerings, and book building. In this chapter, I present the book building procedure in detail. In Chapter 11, I show how the investment bank must develop a distinctive capabilities system in IPOs. The investment bank's reputation is very important for the